Hello, everyone. This is Joseph Trevisani from Worldwide Markets. I thank you for attending this webinar as always. I'm always flattered that people take the time out of their day to listen. As always, when we do these webinars, if anyone has any topics, questions, comments, criticisms, please type them into the chat box and I will do my best to answer them. Today's topic is the U.S. economy in the second half of the year. Now, this particular topic is one I'm afraid that has been done to death, but it is nonetheless one that I think is important for all that we're doing here in the FX space and also in equities and other markets that are trading, of course. The U.S. is probably the most overreported economy in the world. More statistics from more sources, both government and private, including some international organizations and foreign corporations, than any other country in the world. I mean, if you compare it to the other major economic blocks in the world, that would be the EMU, which actually has a slightly, as a group, has a slightly larger, actually the EU, has a slightly larger GDP, and China. It's the difference in the number of statistics, the amount of competing statistics, and the ability to analyze the economy is remarkable. There's so much information coming out of the U.S. that you really are kind of stuck with the old cliche from trading: don't think trade, don't analyze trade. And that's very much true. With the amount of information that comes out of the U.S., it is sometimes difficult to remember that economic trends are long-term, that they change relatively slowly, that any one statistic is exactly that, one statistic. It is, of course, an occasion for trading, which we all use. And for that, it's useful. I mean, I sent out a tweet this morning, actually, talking about the euro over the past 2 weeks, the past 2 weeks sessions, 10 days, including today. The average trading range, I think, is 44 points. And I think I titled the tweet saying a market that only a central banker could love. Be that as it may, the major topic in the world economy, if not the trading economy, is who will, if anyone, pull the world economy along. So we're first going to take a quick look at the EMU and China and Japan, the other major entities in the world. And then we're going to talk about the U.S. and what we can possibly see. There have been predictions about the U.S. forever. Every year, it seems, the Fed says we're going to have a better economy, and every year it just trundles along. The opinion is again the same this year, even though we're approaching the half year, that we are about to see a much more robust set of growth numbers out of the United States. We shall see. It is possible, of course, and I don't want to be a permanent bear as far as what is actually going to happen, but we do need statistics to bear this out rather than just hope. So let's look at China. Now, China has been if not the driver, it's been the driver of hope. China has the biggest, this is exports. Excuse me, let me put up GDP. This is China's GDP. That's this is a quarterly, yearly average. Quarterly, year over year. And this is a 4-period moving average, a year's moving average, basically. The indication this. Now, I have another chart that I want to see if it came through. Unfortunately, it did not. I had some problems with my computer here, which, if you know my webinars, is not unusual. I have a chart on new Chinese yuan loans, which very closely mimics and foretells the growth or decline of Chinese economics. Excuse me. It is, by the way, a lovely spring day here. It's cold, but the sun is shining, and it looks like we might finally leave winter behind. It's been a long haul this year here around New York. So the Chinese economy is not in a position to drive the world. You look at commodity prices over the past 6 or 8 months, you can see that the people whose living depends on predicting commodity prices have all been selling commodities, or at least selling futures, because the demand from China is mimicked by this chart. Now, this is a quarterly chart. Now, the boost in GDP from 2009 was almost all sponsored by money flooding out into the economy, building all those empty cities, factories without orders, apartments without tenants, buildings without residents. It's difficult to actually tell the state of the Chinese economy. If you look on Bloomberg and these charts are all from Bloomberg, if you look on the Bloomberg terminal, the number of statistics coming out of China are very, very small compared to what the United States is. And basically, with one exception, that is market HSBC Economics, which delivers an ISM report, the statistics are all government statistics. So their veracity is questioned. It isn't that they give the wrong direction. They do give the right direction in general. But it's likely that the results, especially in the headline numbers such as GDP, are overstated. Now, this, for any Western country, is a glorious chart. But the real problem in China is given by this chart. This is the yuan. Now, I only ran it for 2 years, but if you look back 10 years, you see a steady appreciation of the yuan until you get to the 2008 financial crisis, at which point the appreciation absolutely halts, and there's a straight line, and then it starts appreciating again. Well, what have we seen this year? Now, remember, the yuan is a managed currency. This is about a 3.5 or 4% appreciation. I don't actually have the numbers in front of me. This is the clearest sign that the Chinese government, the Chinese economic planners, they still have 5-year plans there, are worried about what's happening with the economy, and they're trying to cushion what they're planning to do and what they are doing by increasing exports. Whether or not this is a long-term model for China, China has said for a number of years, their planners have said, and their politicians have said that they want to move the economy to a consumer, a Western model where internal growth sponsors internal consumption, is what's basically behind economic growth, but they've not succeeded in doing that. And the problems that they're experiencing, what they're worried about, is that the loan growth sponsored economic expansion is creating essentially a bubble in the housing markets, in factories. All this production capacity has been built. All these apartments have been built. All these houses have been built. And they're not going to return any income. Those projects were built with loans. When the projects don't return income, the loans default. When the loans default, companies go bankrupt. This is not something on a widespread basis the Chinese economy has really experienced. And they're deeply concerned about it. And that is why the yuan has been forced, if you will, to depreciate. They are trying to cushion that blow. So you're not going to see the driver of the world economy coming out of China, even though it's the world's second largest economy. Well, let's look at Japan, which is, I believe, the world's third largest economy now. Okay? This are Japanese exports. The key, Japan is, in a way, a view of the future. I know I've spoken about this before. Their economy's been in the doldrums for basically 20 years. It's not really growing. It's growing very slowly. The world economy is plagued by an overabundance of production, or as other economists, primarily Keynesians, like to say, a dearth, a lack of consumption. It's the output gap they keep talking about. That means that the world can produce more goods than anyone wants to buy. One of the reasons for that is because every economy in the world is attempting to the same type of development. They are building productive facilities. Well, if there's no one there to buy the stuff, then there isn't much use for those productive facilities. So what Keynesians will say is, well, the problem is not the overproduction of facilities, but the lack of consumption. So therefore, we need to boost the consumption by spending more money, by pumping money out into the economy. That's what all the central banks have been attempting to do. On the monetary side, not the true Keynesian side. The true Keynesian side would be to increase government spending to make up that output gap. But you're having a lot of problems with that. The ECB can't do it. The Fed can't do it. That's not what central banks do. And governments have been restricted because there is another argument, which we're not going to go into. So the great boost in spending that came right after, certainly in the United States, came right after the financial crisis, has very much dissipated. And there isn't that kind of tremendous growth in government spending. And all the Keynesians are screaming that, we're screaming anyway, that there's too little spending. And if you look at Japan, the Japanese have attempted and you can make a very rational argument that the yen is too strong. I've made this argument many times, and the reasons for it don't make a lot of sense economically, at least on trade basis. But it's nevertheless true. So the Japanese are trying to revive their economy, this is the key to Abenomics. They had three arrows, but the first one is to reduce the value of the yen, which they've done. However, look at their graph of exports. Now, where does a lower yen matter? It doesn't matter domestically. In fact, it hurts domestically. Japan doesn't have any oil as the major import. A cheaper yen means oil prices in Japan and gasoline prices and heating prices and everything else has to go up. The place that a cheaper yen could help is in the export sector. Well, look at the recent export year-to-year numbers. Since the end of 2013, they've fallen precipitously. The yen devaluation is not helping the Japanese economy. Well, if the prime plank of Abenomics of the prime minister doesn't work, then it's fairly clear that Japan is not going to be the driver either for the world economy. Remember, some economy somewhere of a large size needs to start growing and to start buying things so that the businesses there will invest, start hiring people, and the so-called virtuous cycle begins. What we've seen from China and Japan does not indicate that either one of those countries is going to do that. For a long time, people were looking to China as the primary hope here because they figured, well, China's got all this money, I don't know, many trillions of dollars that they've earned over the years, and they can just spend that stuff, and that will promote growth in China, kick off a cycle of growth around the world. The problem with that theory is that the Chinese have done it, and it didn't do it. And two, is that all of that money, if spent, has to be spent on something. And we've seen what it's been spent on, as I said earlier, spent on non-productive assets or non-earning assets, shall we say. They have the potential to be productive, but only if they can sell and rent. And the Chinese are reaching the limit of what they're willing to do and what is safe to do in their economy by continually spending money to produce non-productive assets, non-earning assets. Okay, so that brings us back to the other large entity, come on, mouse, in the United States. And so now we're going to take a look, and it's a very, I won't say difficult picture, but it's a picture which has been examined to death, yet it is still the most important. Now, if you can see my screen, I have all of these charts, and it's difficult to choose which one is the one you want to look at for foretelling what's happening in the United States. I'm actually just finishing a piece for FX Street, which will be posted, I think, tomorrow on the U.S. Economic Outlook. And in that one, I'm taking the point of view that let's go with the sector which has traditionally led an expansion, which moves first. And that, of course, is manufacturing. Even though it's somewhere between 10 and 15% of the U.S. economy, it's still a very large sector. Because of the various economic factors, lead times primarily, and also that are involved in the manufacturing sector. Come on, computer. Sorry, my mouse is being recalcitrant today. I'm not really sure why. Okay, come on, mouse. Sorry, folks. I think I need a mouse pad in this room. I have a wireless mouse, which is being very cranky. Okay, so this is the question we're looking at for the U.S. Is the U.S. poised to get some better growth, to grow some jobs, to make some money, to drive the U.S. economy? Looking at this is the Dow. You would have to say, sure is. We are about 100 points, I think, from the all-time high. A little bit, but this was yesterday. I'm pretty sure the Dow is up today. I forgot to check when I came in, but Apple came out with earnings that were much better than expected. I'll answer that question in a second, yes. And a 7-to-1 stock split. If anybody owns Apple, they've got to be happy out there. A 7-to-1 stock split. I think they announced it yesterday after the close. So although I didn't check today, I'm sure the Dow is up today. So the Dow is either at or very close to its all-time record. Traditionally, the Dow is a predictor. It anticipates corporate earnings. It anticipates economic growth. It anticipates corporate profits. That's its role. You buy companies that you think are going to grow, and you're going to get dividends and an appreciated stock price. So looking at the Dow chart, you would have to say the U.S. is poised. Now, I am deliberately ignoring Fed policy here. Two reasons. One, because they say they're not going to change anytime soon. That's what they're saying. That's not true. It's never been true. Forward guidance is nothing more than words. It's the Fed saying we're going to keep rates low until we don't have to, or until it's not in the benefit of the economy. If, for some reason, inflation started to rise, say there was a war in the Middle East or something terrible, and oil prices went through the roof, and inflation started to crank quickly, and expectations rose, which is what the Fed really looks at, then you better believe the Fed would start raising rates, or they'd certainly start talking about it. So forward guidance is nothing more than the Fed saying, we don't think the economy is going to get stronger anytime soon. That's really all it is. And it doesn't mean anything because it will change. It means something, and it's talked about so much you've got nothing else. And journalists have to write, traders have to speculate. You got to go with something. Okay, let me just answer this question. That's essentially it. No, the Japanese have just printed money. They're essentially sending money out into the economy, hoping, by and large, what happened with the yen was interesting. As with the ECB, when Mario Draghi last summer, 2 summers ago actually, said that he would do anything, whatever it takes, I think, to save the euro, what happened was the euro has been on a rise ever since. The speculation before that, of course, was that the Eurozone is finished. Of course, it's not. And somebody's going to leave and the whole thing's going to fall apart, and it didn't happen. So ECB did not have to do anything. That OMT program is not quite a fantasy, but it's close. It's basically the man behind the curtain. My kids are reading The Wizard of Oz. My wife's reading it to them because they're little. And it's the man, and Mario Draghi is the man behind the curtain. If the market had challenged what he was doing, they would have been pulling the curtain aside because the ECB was in no position to actually intervene and prevent it. So, as with that instance, most of the depreciation of the yen took place without the government actually doing anything. It actually started when Shinzo Abe was running for prime minister, and he said this is one of his platforms, part of his platform. And so the yen started to depreciate because traders were willing to run with that. But that has halted. And as you saw from the earlier chart, it has not had an appreciable effect on the Japanese economy. And I don't think it will. I think the Japanese economy has other issues, much more deeply seated and deeply rooted issues, part of which is related to population and other things. So do I think that the Dow Jones will continue to rise? For the time being, absolutely. You are looking at better statistics out of the United States, not great, but better. You are looking at better corporate profits, and there's no other game in town. If you are looking to make outsized trading returns, where are you going to go? If you're looking to make returns, where are you going to go? You can't go to fixed income. You can invest in companies, which is this, or you can invest in the Dow. There isn't a lot of options. There aren't a lot of options. So you put those together, and yes, people have made money in the European stock markets. Same thing. China, no. China has been coming off. Okay, so let me deal with those two questions. So does it look like from this chart, and if anyone knows, they can type into the chat for everyone what the Dow is up today. My guess is, without knowing, that it's up 120 points, and I'm just guessing. I did not check when I came in. Okay, so we have the Dow certainly predicting a stronger U.S. But, again, let's look at that chart. The Dow has been predicting a great U.S. economy forever, and we haven't had one. Okay, let's look at the next one. This is manufacturing ISM. This is one of the chief indicators used by economics and others. Not the only one. There are many. As I said, there are far too many in the United States, actually. And this has improved after a serious fall from the beginning of the year. A lot of people have blamed this on weather. I've never bought it. I don't believe it now. Because once these statistics started to come in, you saw that weather didn't actually have that much effect on hiring or many of the other things. So right now we have the manufacturing. It's down. The high here is about 56.6, I think. The high was 57 right here. Fell off to here, was 50 here. Now you notice that except for this one drop to 49 here, this particular index has not been below 50, which is the dividing line since the recovery started. Now, the recovery started right here in June. This is when the economy stopped falling, June of 2009. Now, the one thing you have to remember about this is the monthly average in the first quarter was 52.7. Okay? That was down from the average in the fourth quarter, which is the strongest quarter since the early part, since the first quarter of 2011, of the 56.7 average in the fourth quarter. Now, historically, not going back just on this chart, but going back to the recessions. The recessions were, did I bring that little, I forgot to bring that little thing. But anyway, covering the last recessions, the average was better than this average, right? We're talking about right now, 52.7, is better than the average between January 1998 and 2007, which the average was only 52, but worse than the 53.9 average in between before the 5 years before January 2008. So we're looking at an economy which has performed okay, and a 52.7 average is not out of line historically. Okay, so listen to these numbers. I'll answer that question in a second. The average for the 5, a little more than 5 years, no, not quite 5 years, after the end of the recession in January 2009. Okay, the 5 years after the recession terminated, according to the National Bureau of Economic Statistics, Economic Research, sorry, in January 2009, June 2009, sorry. The average for that period up till now is 54.2. It's 57 months, okay? After the 2001 recession ended, the average was only 53.7. So for that same amount of time, 57 months, after the 2001 recession, the economy, this statistic has actually performed better. If we look at the 1991 recession, the average for this particular indicator was 52.6. So again, it's performed better than that period. And the last one I looked at was the 1982 recession, which is actually the second half of a double-dip recession. The average for the 57 months after that, during the Great Reagan recovery, was 54. So for the last three recessions, prior to this one, on this indicator, the U.S. economy has actually performed better in 2 out of the 3 of the last recessions in this last period. Why does it not feel like that? Good question. And I'm going to start on that next. And I'll tell you what I think. Okay, let me answer this question. Yes, it's an area which is unexplored. We're observing it now. There have been in the modern era, and through most of history, but certainly in the modern era where you have documentation and statistics, there's never been a country that lost population, except for maybe a war or something, except for wars and things like that, in the modern industrial era. We've never seen this before. And it is not only, as you say, the consumption, the overall consumption that is declining because the population is going down, but there's another factor which is actually of more important, and that is one of my favorite topics, actually. Demographics are destiny. I'm not sure that's entirely true, but it's largely true for a consumer economy. The 70% consumption in the United States based on consumers. As people age, all of us, they spend less money. They become more conservative. They don't take on debt. They consume less. It's rare, the married couple that buys a new house when they're 70. It happens, but it's rare. So in addition to the absolute falling population in Japan, which it is, I think it went down 250,000 last year. This is unheard of in the modern era. Russia has this. Many areas around the world are starting to have this. Is the aging of the population. And it, I think, affects a country, a culture, in unexplained ways, or in ways which can't easily be tracked. Young people are more energetic. They take more risks. I've never been to Japan, and although I hope to go sometime soon, but I certainly don't speak Japanese and would not be able to penetrate the Japanese culture to really understand this. This is just conjecture on my part. But it does seem that an aging population is not nearly as dynamic as a relatively younger population. And this, I think, is probably the main spring of what's going on in Japan. Abenomics cannot fix this. Abenomics doesn't even seem to be able to create export growth because, as the Keynesians like to say, there's an output gap. There aren't enough people out there to buy stuff that's being produced. Everybody's building factories, but the factories and the economies of the places that are building the factories haven't created enough wealth so they can consume all that's being produced. And the countries that have wealth are surfeit. There isn't going to be any huge boost in percentage-wise per population in American consumption or European consumption because wages aren't growing. But we're going to get to that in a second. I do want to cover some more stuff here, so I want to make sure that we don't run out. I'll look at U.S. statistics. Okay, it's 11:36. Why do I think that the Dow will rise? Three main reasons. One is the U.S. economy is tootling along. It does seem to be getting a little better. Four reasons, I guess. Two, corporate profits are better, although there hasn't been a lot of increase in top-line revenue. Certainly for some companies there is. Three, the Fed is going to keep rates low forever, although they didn't say that. And four, there's no other game in town. There isn't any place else to earn money if you're looking for investment money. Okay, so we looked at manufacturing ISM. So let's look at what areas of the economy could drive increased consumption. Okay, first I'm going to look at the production side. First, we look at ISM. This industrial production is 30 years. If you look at the 30, again, this is like the ISM that I just spoke about. If you compare it historically, it performs better than reasonable. Better than reasonably. Excuse me, that should be an adverb. It's better than two of the past three recessions in the 5 months afterwards. Yet, the economy does not seem to be strong. The Fed doesn't think it's strong because it keeps rates forever. Remember, during the other recessions, those performances happened with a far more normal rate policy. You'd have 0.25% for 5 years. You didn't have that. But nevertheless, if you just look at the indicators, it's just like this one, industrial production. The period after the recession right here doesn't look different than this period, or if we could go back here, this period here. So it's probably even a little better if you look at the 2001 recession right here. The production looks like a historically normal recovery. Look at another one. Which one should we look at? U.S. GDP. We could look at that one too. Why not? This goes back again. So let's look. Now, this one doesn't actually doesn't look as good. This is interesting. So you have some of the other more narrow indicators on consumption, on production, looking reasonably comparable to prior recoveries. But that's not true of GDP, right? The 1991 recession, you had a better performance. You certainly had a better performance back here. And even through here, you would have to say it's at least as good or better than the performance here. And remember, this is a Q to Q number, so it's not year to year, so we can leave it alone. So the difference, of course, is that through a lot of this period here, U.S. exports performed well, U.S. manufacturing performed reasonably well. That gave the industrial production and the ISM numbers a better cast than just the domestic GDP, because so much of the domestic GDP is services. Okay, let's look at another one here. So durable goods. This one just came out today, actually. Durable goods, year to year. Same thing. Durable goods. Goods bought to last, both industrial and consumer, to last for more than 3 years. Look at this performance. Now, remember, this is a year-to-year number. So this boost right here is a base effect. You have to be careful of that. This looks great because it's a big improvement over what was going on here. So the numbers here are more realistic. But again, we're looking at a not unreasonable performance based historically. Okay, so let's try another one here. Capital goods, non-defense. This is called, it's a proxy for business investment in the economy. It's called capital goods, new orders, non-defense ex-air. What that means, capital goods bought new orders for capital goods, non-defense, not the defense industries, ex-air, that means no Boeing. And again, the performance is not great. You had a real drop here. So it's not as good as it was here. This tells you that the business is not really as confident. They may say that sometimes that they're confident, but they're not investing. And that's key, of course, to creating jobs. Investing is what's important. So you look here. It's certainly not as good as back here, and it's certainly not as good as back here. So this, in a way, is an antidote, if you will, or a counter to what we have seen. That's an interesting question. I'll talk about that in a second, about the USD. We have a divorce from the typical way that currencies trade, and that's why currencies have been so incredibly boring over the past couple of months, although this goes back a long way. So here we have a bit of a divorce from the production figures we saw in industrial production and ISM. Well, the ISM are attitude numbers, actually. They're sentiment numbers. They're not production numbers. Businesses may feel better sometimes, but they are taking a long view, and they're not investing. They're really not. Remember, this is a base effect. So you compare this to this period here or to this period back here, you can see that it is far less than it was there. So that's one indication. They're not looking confidently towards the future. And that's businesses. Okay. We barely made it back to 1,000, and then it's it's dumped. Okay, look back 30 years. We are below in housing starts, a level that was only pierced once in 30 years. For this entire period, except for this one brief bit right here, and this is probably like a 2 or 3 month, looks like about a 5-month decline. Housing starts never went below 1,000, and I would guess that the average is close to 1,500, even if you discount the bubble. And we have yet, in 5 years, managed to get that level for 1 month, and now it's dropped back down. That's telling you that the builders are not seeing the demand. They're not seeing the demand. Otherwise, they'd build houses. If they're not seeing the demand, what else is not going to happen? All of the jobs and attendant industries that are going with construction. And remember, construction is a job that an able-bodied man or woman, primarily men, can have. It can be relatively unskilled. I've worked construction many times. There are grades all the way up. So it is a job, a type of job that is very useful for people without tremendous skills, without tremendous experience. I got hired as right out of high school, basically, on several construction sites out in the West. I was an able-bodied person. That's basically all I was. I could handle a shovel. So it is very useful for providing the unskilled and relatively low-skilled people in the market with jobs. But it's not going to happen at this level. So two things. It's not going, the housing is clearly not going to drive the economy. It's not going to help build it. This is what the Chinese have done. At one point, I think construction accounted for 30% of GDP. This is bananas. And it's why they're cutting back. And going to face a lot of problems. Okay, let me answer these questions, and then we'll deal with the end of it, and I'll tell you what I think is going to happen here. Okay, the interesting thing about all this data affecting the U.S. and why the currencies have been so incredibly moribund lately, they're not doing anything. The greatest correlation for currency movements is always central bank interest rates. The cycle runs through the health of the economy. Traditionally, what happens is the economy starts to improve more. The central bank starts to raise rates to head off both inflation and overheating. As soon as that starts, you're looking at a year or 2 year cycle. Everybody gets in line. The currency goes up, but up, but up, but up. That's one way it works. You're not seeing that now. Otherwise, the U.S. is right now, at the point we're looking at now, the U.S., without seeing what's going to happen, just looking at what we've seen in the past 6 months, you want to say in U.S. statistics, it looks like the U.S. is going to improve its performance. Maybe maybe 1%, 2.6 in the fourth quarter, maybe 1%. People are going to blame that on the weather. Okay. In the first quarter, and then it's going to start accelerating. That's what's expected right now. What do traders do? They speculate on expectations. So if everybody, most of us, think that the U.S. is going to start to improve, certainly relative to the EU performance and relative to China and relative to Japan, then why is the dollar not going up? Good question. The answer is because one of the reasons that currency would accelerate is because the demand for its assets would increase. So if the economy is going to start accelerating, and that means in a year or 6 months, the bank starts raising rates, the central bank would start raising rates, then you have a reason to get involved and buy the currency. Its assets will start returning more. But that's not going to happen right now. The Fed keeps telling us over and over again. I mean, Janet Yellen in her first appearance, first news conference, made that 6-month comment, and everybody went crazy. She spent the rest of the next 2 months trying to to essentially apologize, telling the markets that's not true. We don't have central bank rate cycles right now. They're not doing it. The Fed keeps saying, we're not going to raise rates. When are we going to raise? We're not going to raise rates. When we're not, never, forever, extended guidance, on and on and on. What are they waiting for? I mean, it's always been my opinion that one of the reasons you see the reluctance in the business side to invest, and after all, jobs don't magically appear. Jobs are created by businesses, not by the government, by businesses. And businesses hire when they have a reason to do so. And the reason would be increased sales or the limit of their productivity. That means they can't produce anymore, so they can't get any more productivity increases. They need to hire somebody. That's when businesses hire. And they have to do it based on their predictions. And one of the things that's absolutely inhibiting is businesses can't predict interest rate costs. If you look at costs for businesses, number one, employees, payroll. Number two, interest. Businesses live on borrowed money. And the inability to predict that, nobody believes interest rates are going to stay at this level. And not only can't you predict your own interest costs, but nobody is sure, including the Fed, or maybe the Fed is sure, because they keep saying, yes, they did. They just did. They just raised rates, I believe. That's why the Kiwi went up. The Fed is telling you by perennially saying forward guidance is going to be forever, they're telling you that they don't have any confidence in the economy. So the Fed's telling you they don't have any confidence in the economy. Businesses are concerned that rates are going to go up sooner or later, but they can't predict when. In addition, they don't know what will happen to the economy, meaning their own sales, when rates do start to rise. So they're not going to plan. They're going to wait. And that's one of the reasons why I think businesses are not creating jobs. Okay. Well, that's an interesting question. I think what we've seen, I'm talking about the home demand question. What we're seeing, I think, is a lot of the movement in prices has been in the lower end of a lot of the purchases have been in the lower end of the market. And not now, but for the prior maybe 2.5 years or so, housing prices were driven up by people buying for cash. That means investors for resale. And that certainly drove up prices. In addition, until 10 months ago, we had extremely low interest rates. They're still low historically, but they're not as low as they were. But what you're seeing now, I think there was people didn't buy homes for 2 or 3 years after the recession, basically. And there's a lot, the economy didn't fall apart. People still have jobs. Many people still have jobs. So there was a lot of put off home purchases. Purchases were put off. A lot of those people started to come back into the market, as we did, my wife and myself, once things stabilized and gradually got a little more confidence. Going forward, though, I think what we're seeing is not the rebound, but we're seeing the steady state, which I think you're going to see is much lower until jobs start to get created. The people who were still able to buy homes didn't for a few years and then did. But now that's not a ever increasing class group. It is a group which didn't and then did and now is finished. The steady state, the long-term health of the housing market is dependent on the job market. And we are barely creating enough jobs, now a little bit more, to keep up with population growth. And although, yes, I know recently the number of jobs the number of people employed, I believe, finally reached the level that it did that it was at just before the recession. However, that's almost 6 years ago. The population has grown, so the percentage of people who have jobs is still very much lower. Okay, Let me look at this. Yes, New Zealand is raising rates. I believe it was they had a boost in inflation, but I'd have to, I didn't actually follow that. I saw it, but I didn't actually follow it. I'll be glad to deal, but we should probably deal with that next time. But yes, they are. No. There are two things going on as far as Janet Yellen goes, and then I want to look at one more thing that I want to make sure we have time for, and we do. Okay. If you look at the 10-year rate, once it went up and then looked like it was threatening to go above 3%, and Bernanke slapped it back down, you've had a much cowed credit market. I know that I think it was supposedly Bill Clinton who said, when I come back, I want to come back as the credit market or the debt market or something like that because it's all powerful. It's apparently not. Same thing happened in Europe. Mr. Draghi, and I'm sure the government's behind him, cowed the speculators in sovereign debt. So, two things are going on. One is the quantitative easing program. Now, they're reducing $10 billion a month. I think they're going to continue doing that. There's absolutely no justification for not doing that. So I think they will. But yet, rates haven't gone anywhere. Mr. Bernanke's warning, and I believe this, directly to the credit markets, he didn't say it, by not starting to end QE in October and then doing it in December, that slap at the credit markets in October is remembered. So even though the Fed is reducing its QE, rates are not going anywhere. So that's one way. The Fed has got what it wants. It wanted to be able to reduce QE, but it didn't want rates to rise. Nobody's talking about this, but this is what's happened. So that's one thing. The actual increase in the Fed funds rate is of far less importance in my mind, because what we're talking about are the rates in the economy. Credit card rates, mortgage rates, car loan rates. Those are the important rates for economics, for economic growth. Those are the ones the Fed was worried about. Those are the ones I think that the Fed started to freak out about last year when Bernanke first started talking about beginning to end QE back in May, and the rates went crazy. So that's what I think is important. If the credit markets are no longer keying on the Fed rate cycle as indicated by the Fed funds rate. Quantitative easing is monetary policy by another name. They're all calling it, it's not. Many people said it's not interest. It's nonsense. Of course, it's interest rate policy. Everybody knows this. Anybody who says QE is not interest rate policy, it's monetary policy, is ridiculous. It is. It is. Of course, it is. The reason they're doing it is because they can't do anything else with the actual Fed funds rate. So the time will come when the Fed can no longer threaten the credit markets. Right now, the Fed is reducing quantitative easing, but it's still got $55 billion a month. Okay, if credit rates, if the 10-year rate, for instance, started to rise, and the Fed got worried about it because it was going to raise rates throughout the economy, what do you think the Fed would do? At one FOMC meeting, they would say, we're not going to reduce this month. The credit markets would go bananas. They're terrified of that. They're not going to threaten that. So I don't think you're going to get any real appreciation in the rates, which is exactly what the Fed wants, until quantitative easing finishes, which sometime in October, near the end of the year. Because at that point, it's going to be much more difficult for the Fed to turn around and start it up again because it thinks rates are too high. Remember, what all of the central banks have done, their basic policy is to support the economies with low rates and quantitative easing and liquidity until the economies start to recover on their own. to stretch it out as long as possible. That's the basic rationale behind everything that they've done. Everything. That's what the Fed's doing. So once the QE ends and that threat to the credit markets is reduced, I think you will start, if the economy still continues reasonably well, I think you will see rates start to rise. Okay, now, I'm almost finished here. No one from FX3 has said I have to be done yet, so let me just do one or two more things and I'll show you. This, I think, is the key more than anything else to what we're looking at. And why, even though I think the U.S. economy is going, and there's not going to be anything original what I'm about to say, but I want to say it anyway. Why we don't have strong economic growth and why we don't have strong consumption growth. Okay, this is personal income. Take a look at this. There is a very unpleasant downward movement, and this is year-over-year personal income. Remember, this right here is base effect. This is, that's a phony spike. It has to do with a change in tax policy where everyone took their, I think it was before capital gains was set to go up, and everyone took their profits. So that's not a true spike. So if you look at this, this is why you don't have a strong recovery. 3.1% is peanuts. Look at what we've got back here. Okay, there's this one brief period. Remember, this is base effect. Look through here. You've got well over 4% most of the time. Many recoveries steadily over 5%. Let's try another one. Average hourly earnings. This one's even more dismal. Look at this. Average hourly earnings. You know what inflation's running? Headline inflation, because that's what people pay. I don't really care, and this is what the ECB does. The ECB, no, I don't believe these charts are inflation adjusted. I don't believe so. That's why I'm comparing them to the inflation rate. The average hourly earnings, 2.1%. What's inflation running? 1.5%. And look at how this has sustained itself throughout this period. From 2010 all the way up. There's very little economic growth. People don't have more money to spend. And this, I think, more than anything else, is the reason why we haven't had a stronger recovery. If businesses don't hire, and hiring by business is not subject to admonition, meaning people won't hire simply because someone tells them to. You want to stay in business, you hire for a reason. And that reason has not been forthcoming over the past 5 years. This is the other. Remember, if you're looking at growth, remember how all the inflation, all the unemployment numbers work. If you stop looking for a job, you're no longer counting. But what does this tell you? This is labor force participation. This tells you that not only are people not making any more money, but there are fewer people working as a percentage of the population. There is less money being spent as an absolute number. Forget about changes month to month and all this other stuff, because fewer people are working. And if you don't see the growth in expenditures, I actually have a chart on that right here. There's personal consumption. This is personal consumption. Look at this. Same thing. downward cast to the chart, less money available for spending. So yes, the first charts we looked at were manufacturing, and they actually compared well to prior recessions. And the reason is, as I said, manufacturing has a strong export component. Much of the rest of the economy is domestically driven. And this is not the sign of a robust economy. You are not seeing the type of economic income wage growth that will let people that's an interesting question. Fewer people, the inflation doesn't have, you know, I know there's the Phillips curve, but I don't really buy that very much. The inflation is based on demand. What we've seen right now is an interesting item. The Fed has been pumping money out like crazy, and there's no inflation because there isn't any demand. There's no wage inflation because people can't find jobs. So there isn't any reason, and because there isn't as much demand, companies don't have pricing pressures. The housing story is a little different, and I think I went through that. So the inflation rate is low primarily, despite the flood of money, because there isn't enough demand to drive it up, both on the wage side and then on the pricing side for the firms. So you're not seeing the kind of, I remember when, you know, the Fed started doing QE, you know, 4 years ago, inflation, gold went up, everybody was terrified there was going to be a tremendous amount of inflation. Mr. Bernanke on this case and the Fed have proven absolutely right. There's no inflation because there's no demand. And if firms can't demand a premium because nobody is buying, or relatively speaking, then there's no way they can raise prices. And that's different. One of the things with housing, of course, is that there's been much less housing built, and there was a huge delayed purchase run because nobody bought a house right after the recession. Okay, I think we'll end here. We're running over a little bit. I thank you all for attending. Let me just give you my summation on this. Now, right now, we're looking at predictions and expectations on, there we go, the Dow, if you want to take that as an indicator, that the U.S. economy is going to perform much better in the second half of the year. Now, what do we mean by much better? In my guess, I doubt very much we're going to get very far above 3%. You know what I think? I think that the U.S. economy is going to perform somewhere between 2 and 3% for the remainder of the year. That is not strong. It's okay. I don't see the demand side driving economic growth. I don't see jobs running up. I don't see people getting more confidence that they're going to get a raise. There's nothing in either the consumption or the earning figures that predict a stronger consumer economy. Businesses always get optimistic, and then they cut back. That was one of the reasons for their fourth quarter growth. Remember, it was originally 4.1%. Inventory build. So even though businesses are now looking a little more optimistic, unless there is the realistic appreciation, delivery, they actually see the sales. And I'm not talking about Apple. There are always exceptions. There are companies that prospered through the Depression too. Not many, but they did. Talking overall. So with that, even though you're getting a lot more optimism now about, it's springtime, maybe everybody's just glad the winter's over. I don't see the economic drivers for a much stronger growth, for something that leads you to 3.5% or 4%, at which point you can really start to see jobs and the cycle produced by hiring. Okay, will the dollar, this is a very difficult question. I have thought for a long time that the dollar would get stronger. It has not. it's difficult to look at the traditional economic determinants, economics, strength, economic growth rates in the country, what the central bank is about to do, and not predict the dollar is going to get stronger. That's the only logic you can do, that it hasn't so far. And I think part of the reason is the same reason that the credit markets are not increasing rates because they're afraid of the Fed. The Fed's going to slap them down again. I think you're seeing a similar thing in the currency markets. The Fed has said we're going to keep rates low forever, okay? So even if you get stronger growth in the United States, the Fed has said we're not going to raise rates. Okay, well, that cuts out a leg from the credit cycle. The ECB has said a number of times, many times actually, all of the ECB folks over the past couple of months, the euro is too strong. Is the euro going down? No. Why? Because nobody thinks they're going to do anything about it. And they have to do something about it. If they want it to go down, they've got to act. They can't just talk. They've already had their talk. So until there is an act on somebody's part, the ECB or the Fed, that and the end of QE hasn't been enough. Why? Because the Fed keeps saying, if things change, we're going to ramp it up again. They're not being so specific, but that's the threat. That's the absolute implicit threat every time they talk about QE. So although they're reducing it, nobody's going to act on it because they can still reverse it. And everybody's got slapped last year. And I think you're seeing the same thing in the ECB. So until there is an act, I think we are stuck as to what will change the currency rate. Much like the Fed, much like the yen being very strong for so many years without any real economic logic to it. But there was no reason for the currency markets to move. I think we're seeing the same thing here with the dollar. Okay, folks, I thank you all very much. I apparently ran over. I guess there's nobody afterwards today. I thank you very much for attending. I take it as a great compliment that anyone takes time to listen to me on this. If anyone has any questions, comments, considerations, or critiques, I will put my email address in there, and please send me the comments. And again, thank you very much, Adinda, who's actually in Indonesia, and the rest of the FX Street people for this opportunity. Everyone take care, and thank you very much.